All right, we are moving on in our program. We've already heard we haven't observed too much innovation in Swiss asset management during the last 20 years. That's why the following title sounds promising: revolution or evolution in asset management. That's the question, and that's what Dr. Christoph Bürer, partner and CEO of 12 Capital, is going to talk about. According to Wikipedia, the definition of evolution is as follows: evolution is the change in the inherited characteristics of biological populations over successive, and now you need to listen carefully, over successive generations. I really hope that Mr. Bürer is not going to vote for an evolution, as we need to go with generation, but for a revolution in asset management. Thank you for joining us. I'll hand over. Thank you.
Thank you. I think, or I suspect, you have now raised the audience's expectation. So I should probably start by managing expectations, because the talk will be rather basic, even simplistic, just designed to illustrate a couple of key points I'd like to make today. The second thing I'm going to mention before I get started is that the Canton of Schwyz, our host of today, they have committed considerable time and resources to make this event happen. So in appreciation of these efforts, I would say that 12 is very close to the location Pfäffikon. Our venture was conceived here in Pfäffikon. We started out as a company, 12 Capital AG, incorporated in Pfäffikon. And even though we are now managing our business mainly out of Zurich and London, we still operate two companies here in this place. I'm not sure about you would derive any value out of this, but believe it or not, I even met my wife in this place. So I think there is something magic about being in Pfäffikon. But I'm going to leave it with that and move swiftly to the actual subject matter of my today's talk. Fundamentally, investment management is about taking investment decisions for on behalf of third parties on a discretionary basis. And as a rule, that happens against a fee. And just to make sure to illustrate where the talk fits in the overall scheme of things, I believe it's very important to draw a distinction between the investment management level and what I call the investment facility level. That is the funds, the managed accounts in various shapes or forms. Because when discussing initiatives, I think it's important to bear in mind that these businesses see quite different dynamics and need to be addressed in different ways. And also the actions derived out of this would differ. Now, let's have a very brief look at the value creation chain in investment management. What clearly springs out is there's two key value drivers. It's the actual investment performance generation, and second, it's about raising and notably also retention of assets. If we decompose the portfolio management piece a little bit, and if we drill down a little bit further, we draw a distinction between sourcing, analytics, then the actual relative pricing, including structuring, and the portfolio management in a narrow sense. Sourcing clearly differs pretty much in terms of business model. As long as you play liquid, that's not too much of an issue. These investment opportunities will always find your way to you. It's much more different in the actual illiquid markets, where you have to make sure that you see the deal flow, that you have access to the investment opportunities. When it comes to the analysis, I think it's very important to fully understand the actual opportunities, the dynamics involved in certain investments. And this is often driven ideally by proprietary assessment, certainly in our firm. Then it comes about, when you understand this investment opportunity, to establish a certain technical price. And you need to then look at what's the market offering. Is there mispricing you can basically detect or exploit? And do you really get the adequate compensation for the risk you assume? And then in portfolio management, it's about the execution of things. It's about the sizing of the trades. It's about portfolio construction and ongoing management, where you can also squeeze out, depending on the business model, some extra performance. All these things should happen in a properly risk-managed fashion, certainly in the institutionalized world. And it's also complemented by operations and compliance. The last elements I've just mentioned don't really make for good differentiation. You just have to keep up with developments. But the actual performance generation is where you can make a difference. in their quest for efficient portfolios, a lot of investors have adopted the core satellite approach. And clearly, the satellites tend to be managed in a more active way. It's more innovation-driven, more skill-driven, as opposed to the core investments, which is largely basically rule-based, more formulaic, process-based. And it's about size. It's about razors and margins, and it's about really size. And how far size can get is something these charts would illustrate. The chart is actually silent about the locations, but clearly these are all investment managers based in the US or the UK. There's a little bit of Germany here, but more on the, I think, on the shareholder level, and not so much on the actual investment management level, the actual performance generation level. Clearly, distribution is a different story, because this is distributed on a global scale with a lot of distribution power as well. That makes these companies grow even further. And there's certain herding also involved that the large attract much more assets going forward. I think I've covered this slide pretty much. Maybe just one point about the margins. Of course, passive investment is about thin margins, but large volumes. On the satellite investment scene, I think it's about higher margins, but we also should bear in mind the actual product life cycle. New products become old products, new type of assets or asset classes become old type of asset classes. So with this kind of evolution, there's also commoditization of the business, and that certainly involves erosion of margins as well. Now, having looked at these observations in a very, very brief fashion, I would conclude that clear positioning is required. You either play core, passive, or you play satellite, more active, not too much in between. If you decide to engage in the satellite play, it's fundamentally important to have the right skills in place. And also, I think, within the satellite area you've chosen, you should be among the top providers, certainly top 5 or top 10. Otherwise, you will have a hard time making it to the long list or the short lists of the investment consultants. Then, in contrast to the past, I think content matters a lot. First and foremost, the primary focus is on performance generation. It's also about transparency. I think you will have a hard time selling black boxes going forward. And third, when it comes to distribution, there's clearly value in relationship to make sure you get access to investors. You can maintain investors also when performance throughout a certain period is not terribly compelling. But still, relationship on its own will not do the job. In the institutional world, we essentially live in a world where it's very much committee-based, consensus-oriented decision-making, and content will need to make a difference. Last, I think regulation does serve as a catalyst, because I mentioned scale. Also, on the satellite level, scale matters as a minimum efficient scale, I believe, because given the recent regulation, the actual entry barrier has been raised, and it's much more difficult to get going. So I think it's very important to make sure we still maintain innovation power in that context. So how did 12 go about this against this background I've just outlined? I think essentially 12 was founded based on the principle that insurance markets are rather opaque, intransparent, and certainly at times inefficient. Insurance is subject to specific rules in terms of regulation, in terms of accounting, and there's also a wide array of risk one has to understand. So we felt this opaque space makes for a good business area, and it also takes pretty fundamental insight to identify the opportunities and also to exploit the opportunities. So that's essentially the background. On top of this, we believe insurance per se as an industry has a bright future. Think of the ever-increasingly interconnected world, which becomes much more vulnerable. On top of that, there's increasing value accumulation in catastrophe-prone areas. People want to buy protection against this. And certainly on the life side, the aging population is calling for private sector solutions. So we feel insurance per se is a pretty nice place to be in, given the opportunities one can exploit. And it's not so much a crowded market, it's certainly underserved, I would say, from an investment management perspective. So we decided to go for the niche play, and that per se makes for differentiation. But it doesn't stop there. Often, when investment managers look at the insurance space, they look at insurance-linked securities, essentially trying to extract the genuine insurance risk, make that accessible to the investors as a low correlation investment, which still offers decent yield. We decided to go beyond that. We do effectively cover the whole balance sheet, so it's insurance-linked securities, liquid and illiquid. It's also about debt issued by insurance companies, liquid and illiquid, and it's also about equity, both in liquid and illiquid format. So as a clear differentiation, we cover the whole balance sheet, but it doesn't even stop there. We still push it one step forward. While offering all these products I've just mentioned on a standalone basis, we also combine these to exploit best relative value in the insurance space, and refer to this as best ideas. So it's really the forefront to the development in the insurance investment field, I would argue. If you want to do that, clearly you have to have the right team in place. You need to have these specific skills, and also you have to be credible in what you do. Hence, very important. Certainly we think in terms of strategy, structure and people, but in our case, the quality of people, if you play niche, is of paramount importance. We certainly believe in very strong academic foundations. We certainly have, I think, quite well-established interaction with academics, but also based on our workforce, some 30% of our people hold a PhD, 90% of our people hold a master's degree and even advanced degrees on top of that. We also place a lot of value on relevant experience. So all the senior people in our firm have covered the insurance space either as an analyst or from within in excess of 15 years. So that makes for applied academics, so to speak. We also embrace diversity along multiple dimensions. And there's really many, many dimensions you can think of. And a key theme in our firm is integration. Because insurance, as I've just mentioned, is rather complex. When you tackle this from an investment management point of view, you have to make sure that people do integrate across the balance sheet, across the disciplines, across the value creation chain. So that's a key theme we are fostering. Plus, it's about making sure there is innovation. So we try to maintain an intellectually stimulating climate. We place a lot of emphasis on contradiction, because only contradiction will allow you to improve and will allow you to innovate. This graph is just meant to visually capture what I've just mentioned. There is the insurance company balance sheet with a lot of underlying risks. It's the actual insurance risk, the underwriting risk, but also the market risk on the left-hand side of the balance sheet, the credit risk. It's about operational risk, even management risk. All these risks need to be understood. It is about the genuine risk, which I've mentioned a minute ago, when it comes to insurance-linked securities. It's all the rest of the risks which are exposing debt and equity, which differ in terms of loss absorption features. And you have to understand that as well. We have developed also not only a credit rating, but also a legal rating based on the actual prospectuses and all the features of instruments. We have developed a combined rating approach, which allows us to determine a rating for a certain security in the insurance space and compare that with the actual market price, which allows us to detect mispricing and exploit that actively. So you would see the standalone asset class products, intrinsic securities, debt, equity, but also the best ideas, exploring best relative value within the insurance space at a single point in time. And we are trying to execute on our vision and our version of ROI, which we call return on insurance. It's also about maintaining and developing a platform. We very strictly think that investment management is the core of things. It's our engine. And risk management and business management are just meant to support that. In our case, sourcing is a very, very important function because insurance is a pretty much closed industry. You have to have access to make sure you seal the deals. You have access to the deal flows, especially when it comes to more illiquid, more private solutions. Then it's about the analytics. I think it's fair to say that our business model is centering around the analytics. It's very fundamental research. It's bottom-up insight, driven by the analytics team, but also driven by proprietary tools. So this is where we basically generate alpha. And on the portfolio management and also the execution trading, there's something you can do, but there's a limit. So I think it's the fundamental insight, very technical orientation with a certain macro overlay, but that's what we're focusing on. Now, when it comes to executing on this vision and designing the business model, we basically serve institutional investors. We make these insurance-related investments accessible to the institutional investor world. And when we talk to the investors and interact with them, we have to act, behave, and sound like an investment management firm. We are also regulated as such. When it comes to the investment side, with the funds raised from investors, we do facilitate the provision of capital in the insurance and reinsurance world, which means that we have to act, sound, and look like either a reinsurance company or an investment bank within the boundaries of regulation. We also interact with, clearly, investment consultants and intermediaries and brokers on the insurance world and also the banking world. The key challenge is to combine these two worlds. It's about convergence of capital markets and insurance markets. And that's what I meant by integrating teams as well. Integrating different backgrounds, making sure they're all on the same page. The other aspect I'm going to cover briefly is the partnership structure, because I truly and honestly believe that's a very healthy form of organization, especially in investment management, because there is very obvious agency conflicts. It's the investment management firm and the investor. It's the investment management firm and the employees. A partnership structure helps big time to align the interests of all the involved parties. While formally we operate a number of operating companies limited by shares, we also maintain a holding company. And on top of this holding company, there's a shareholder agreement, which I consider to be the key governing document of our venture, looking at how the company should be run, how the investors are represented. It's about entry and exit of partners as well. This makes for a pretty much a long-term orientation of the people involved. It also offers a quite sustainable basis, which is often valued by institutional investors. It's also about an entrepreneurial attitude and also culture, because I've just mentioned the importance of integration. The partnership fosters integration. It makes people think about the bottom line, not just about their own incentive scheme. People do integrate, think about the big picture. They're also very cost conscious. In our case, the corporate credit card is not just an ATM equivalent. People try to save money and spend money wisely. It's also, when it comes to hiring, which I still think is one of the most challenging tasks when running a firm, it's a certain application of this economic concept of self-selection. Because if you have a very clear profile as a partnership, people would make themselves known and find their way to you. Also, when having interviews with people, it's quite revealing whether a person asks you about the long-term perspective to acquire shares versus nitty-gritty fringe benefit aspects. People really show you who they are in that context. In addition, I think I always say people interested in our venture, I cannot guarantee that we don't make mistakes. For sure we do, and quite a lot of them. At the same time, there's a genuine interest to be fully compliant, to preserve franchise value. I think that's a very, very healthy catalyst as well. So partnership clearly offers the skin of the game aspect of things. On top of that, we are also invested in our own products. So I certainly think it's fair to say that we think twice before making investment decisions. Just a brief sketch of our history, because a lot of people are quite impressed by the fact that we went from essentially 0 to 3 billion in less than 4 years. So are we. We had Urs Ramsayer, our chairman, built the Horizon ILS investment team, which by Horizon was identified as a megatrend, which I still think still holds. The benefit of this was that as a team, as a core team, we went through the financial crisis. And we certainly could see how people act under stress, which is an invaluable insight. If you would have started today, would have assembled a team, we would have had, I think, a more bumpy start, for sure. Then we executed on the spin-off. We launched private label products in order to optimize time to market. It was the ILS business, but also the sub-debt business. We essentially were able to convince people because all we had was an idea with a clearly mispriced instrument and a certain team which I think is credible, and that helped a lot. A key step then was in July when we got the first real big ticket of an institutional investors, PKA, which is the Danish pension fund of the health profession, it's the doctors and the nurses. That did tell us that we are due diligenceable for the institutional investor world, which is even more important than regulation, other than making sure you have a right to play. Also, we maintained virtually no sales force. Very, very few resources could be dedicated to asset raising. So what we were looking for was a partner which offers distribution power and also infrastructure, so we could focus on investment management. Saracen at the time was bold enough to take on 12, and I think this is a quite remarkable story with an insurance bond fund which went through the roof performance-wise as well as asset-wise, volume-wise. We also then launched a cat bond fund, and it took us 2 years basically to reach the 1 billion mark on the basis of quite decent performance. Then we were facing, like many of you as well, the regulation challenge. I must admit that we felt FINMA was acting in a very professional manner. They did understand our business proposition, they did understand our products, and they were quite constructive. So we certainly prepared well, but we got the license within 3 months. Then, again, also within the satellite, the minimum efficient scale matters a lot. This is why we entered into a transaction with Falcon. Without being or doing fully fledged M&A, we could secure the investment management of the funds, we could combine the best of both worlds, and also increase our ILS business under management, because it really takes a lot to run this business based on the models involved. So in October then, we reached the 2 billion mark, so it just took us another 9 to 10 months. And then we think it's very important to continue to be innovative. We launched the private debt initiative last year, which is about exploiting opportunities in the insurance space on a debt basis, also against the background of the transition of Solvency I to Solvency II. If you look at the insurance landscape just in Europe, there's only 70 insurance companies which can raise funds in the public markets. There is in excess of 5,000 insurance companies out there only in Europe having a hard time accessing capital. So we believe that's a massive opportunity. And then we also launched some best ideas mandates without even selling this, but maintaining a certain dialogue with our investors or key investors. We launched this as well, and it really does perform very decently, I shall say. This then took us to a 3 billion within just another couple of months, and we then reached out to the marketplace London. The key triggering point when moving to London was resources constraints. We operate in the insurance field, and there's not too many analysts covering insurance actively. There's a much larger pool in London. We were successful in attracting some people and bringing them to Zurich, but it would have been an impediment and limitation to growth. So this is why we moved to London. Of course, it's also about covering the institutional investor base. It's covering the consultants. It's making sure we have access to the European Union as a market. So just a few comments now on how we turned the startup into the established investment manager. It is very important to us to keep focus on investment management, on performance generation, because we really have to build the business. It's building the team along the lines I've just mentioned. It's also about massively institutionalizing the business. In the early days, in our organization, everyone did everything. Now we had to introduce separation of duties, which cannot be maintained by a small team. It's about process and systems, because in the startup, things are pretty much driven by individuals. You have to make sure 12 invests not based on people, but there is a sustainable, repeatable investment performance generation process. It's also about making things much more robust, scalable, and you still need to maintain optionality, because things may go either way. We had to introduce management and communication. Imagine in a startup, the partners, they are all on the same page, inevitably. You discuss business plans and cases in the office, over lunch. There's no need to communicate. But as you grow, you have to establish this management layer. You have to establish communication lines. So I think the pendulum must not swing too far into the institutionalized world. It's about being nimble, maintaining flexibility and innovation power. And outsourcing allows us also to some extent focus on investment management. I think I've just covered that one. So in short, I would just say that 12 is a case which illustrates that Switzerland does offer fertile ground for the growing of emerging managers, specialized investment managers, but there are clear limitations.
Thank you, Mr. Bürer, for your presentation, for sharing your insights. The break is ahead of us. Just one question. Is there one question from the audience? Over there, yes.
Thank you very much for this nice presentation. I have one question. We talk a lot about regulation here. Regulation is typically a hurdle in terms of accessing the asset management market. Do you also see it as an opportunity, for example, to have now, due to regulation, you need more risk management systems? Do you also see this as an opportunity of providing better products or better services? Thank you very much.
I would tend to agree, but I'm going to make a couple of points. I think one is that regulation is just the minimum standard. And at 12, we were lucky that the very moment we had to institutionalize, we were hit by the regulatory wave. So we had to do something about this anyway. But still, I think regulation is just the bare minimum standard. If you want to play big institutional tickets, this is what I was referring to as quasi-regulation. If we talk to large investors, they do very intense due diligence. They look at our, for example, gift policy. FINMA was fine with our gift policy. I think it was a decent document. But they spotted it was the 300 Swiss francs allowed. It should be 100. They looked at our entry system. They told us a key is not good enough. You have to have a swipe card which is recording entry and exit. It's about the systems. You shouldn't manage things on a spreadsheet. We have committed quite considerable effort to introduce a portfolio management system, which offers automated pre-trade compliance and all these things. So I think the real reference point is what the institutional investors would expect. And that really is a big change, a big challenge for the business as well, especially in a small context.
Okay, once again, thanks very much. Mr. Bürer will be on stage later on, again, on the panel. At this point in time, ladies and gentlemen, I'd like to thank all the sponsors for their big contributions for today's event. You will see the logos on the screens later on. I've heard that we have many illiquid assets ready outside for our morning refreshment break. It's now 10:25 almost, so please be back at 10:45. That gives you around 25 minutes for breaking. Thanks very much. See you later.